I have called this Celsius breakout was going to happen around about a month ago in a previous video, and now it has finally happened. I am a bit salty though. My stop loss was triggered last night just around here as the stock dropped 10%, but now they are up 50% on the week chart. So I have actually missed out on this profitability. There's not a lot to say really. It's quite annoying, but what can we expect to see in this stock going forward? Is there still room for growth? In this video, we're going to be looking at their intrinsic value per share on a yearly and 9-year basis on a discounted free cash flow analysis. This will help us understand exactly where we can expect this stock to head in the next few months to years, and help us decide whether or not it is still a good stock to be buying into even after this breakout. Now, it is very early days for Celsius, as we can see. I do not use an ad blocker. As we can see that we have now just had this massive breakout, and there could be a lot of momentum behind the stock. As the stock is now above all of the moving averages, we can expect there to be a lot of momentum, but that isn't necessarily exactly what's going to happen. As we can see here on the RSI, we are now overbought on a 15-minute chart, and if we go to a daily chart, we can see that we are still actually in a short position on the MACD indicator, and if we look at the moving averages, we can see that we are above all except from the 200-day moving average, which I would say is still a really good indication. With Celsius's earnings report coming out on the 20th of February, which is when the stock dropped 10% and then all of a sudden shot up, we can see here that they didn't meet expectations. They were actually down 199% on the earnings per share, but we can see that on the revenue they were massively up, being around 2% better than expected. Bit of a shame that I lost this position. Of course, I was sleeping when their earnings report came out, and I just missed out on the fact that my stop loss absolutely cock blocked me in a way. It's not something I'm happy about, to be perfectly honest. My system kind of failed me there, and there is room for improvement. You live and you learn, but it's a bit of a shame. So now let's look at their financials. Before we look at their financials, actually, I'd just like to point out why I still think Celsius is such a good stock. They are a health-orientated energy drink, which is primarily North American focused, and they are expanding into Latin American and European markets within this next year. That's the plan anyway, and they have Pepsi to help them do this. So there is a lot of financial backing behind this company at the moment, which will compete in the long run with companies like Rockstar and Monster. With Celsius's revenue being down 4.4% in Q4, primarily due to an expanding distributor incentive and domestic allowance increases. While North American revenue dropped 6%, international sales grew 39% to $20 million, which is of course what I was speaking about just then, where we have now seen plans for them to expand further into international markets. So what is the current financial health for Celsius? Well, here we can see on a liquidity ratio that they are massively... That can't be right. Surely I've done that wrong. Let me just double check. Turns out that is right. Their liquidity ratio is in the hundreds, which is absolutely crazy. For every dollar of debt in which they owe in the most recent quarter, they have had $154.8 of liquid cash to pay this back in, which is actually outrageously good. That is the highest liquidity ratio I have ever seen. If we look on the retention rate, we can see here in the most recent quarter, which isn't the one just gone, as we don't have the actual Yahoo Finance data for that yet. We can see that the retention rate was 2.4%, which isn't actually good, but when comparing it to its previous quarters, we can see that that seems to be an anomaly. And if we look on the free cash flow here, we can see that free cash flow is somewhat... In fact, it's not at all steadily increasing at all. I can't exactly say that for this stock. But it is positive, which is a good thing, and it does seem to be as if trend lines are projecting this to only decrease, which isn't a good sign. But with it being positive and their liquidity ratio being absolutely unbelievable, I think I can look past that. If we look here on a 365-day exponential chart, when I move my webcam, we can see here that on the year, we are currently massively down, with us being up slightly today. Well, not slightly, it's up about 50% in the last couple of days. And the volume following suit. This shows that this sudden spike in price is actually supported to an extent, which is good. Obviously, it's a bit too early to call any sort of shots with that you know, it is looking good for Celsius on a daily chart. It looks to be as if this could be the start of a breakout, but I don't want to say too much on that. Only time will tell. I don't want that to come back to bite me. Looking here on a 91-day chart, we can see here that it's the exact same story with volume increasing as the price has actually been decreasing. It's looking to be as if we are now entering into a breakout territory. What the figures for Celsius, they have a PE ratio currently of 42, a 52-week high of 99 and a low of 21, this being a difference of 78 and the current price being set at 33 with a beta of 1.89, and the company was founded in 2005. We can see a growth rate here projected at 18% with an average growth rate plus surprise rate of 15, as we can see here in this quarter, which you can't see in this quarter here. They were actually way off target, so we do have a 15.9% growth rate in my system, and we can see the current EPS is set at 0.79. So what exactly does this say when you input this into my system? Well, currently it looks to be that Celsius is actually overvalued after this recent hike, which I'm going to say this now, I don't think is fair, and I will explain to you why this is in a moment. But here on the left, we can see an intrinsic value per share being set at $29, with the current price being at 33. This obviously gives us a difference of 115%. And if you have a margin of safety of 25% on this, we can get an acceptable buy price at $22. Looking on the right here, we have an intrinsic value of 16, which is the bearish intrinsic value, with a acceptable buy price at 12.4. Going in between the both of these, we get a mean of an intrinsic value per share of $22.9 and an acceptable buy price at 17. I don't think this is fair. I think it's fair to say that we can remove this growth rate in this instant, purely just because I don't think that it really reflects the price and the future potential too well. But we can see when I remove this that we are now actually just bang on the intrinsic value, with it being slightly overvalued currently. But obviously there is a lot of momentum behind this stock at the moment. Once I adapt the growth rate up to 22%, we can see that the current price is actually below the intrinsic value, which is set at $38, but with a margin of safety of 25%, we can see the acceptable buy price is still below the current price, which is what I was saying in the previous video. I was saying that this stock could go all the way up to $30 odd, and that's exactly what it's done within the space of a couple of days. Of course, I have missed out on this money, which is quite annoying, but we live and we learn. So what can we see on a Peter Lynch's valuation? So here we can see a result of 0.5, which means this stock is currently looking to be overvalued. But when it says overvalued, I like to say it is fairly valued, as this is extremely bearish. So on a discounted free cash flow analysis, what can we see for the next 9 years worth of growth? Well, down here we can see a a discounted free cash flow price per share set at $85. This is accounting for the 22% growth. And if we move this back down to an 18% growth rate, which is what the analysts projected this stock to be at, we can see the intrinsic value on a 9-year basis is set at only $63 based off of their current free cash flow. So it could be that this stock is starting to look relatively overvalued, and it might not have much more intrinsic growth, if any, left in it. I think it will be purely momentum that carries this stock further now. It has reached where I think it's fair to be at the moment. But just because it's reached its intrinsic value doesn't mean that it's not a good stock to be buying into, as you will be buying into future operations for this company at this point. Intrinsically, we are exactly where we should be, as I've just said, but that similar story with Hims and Palantir. It doesn't mean to say that if you're buying in, you are buying in at an overvalued point, but momentum could definitely help see this just continue to rise, as of course they have been massively beaten down in the last couple of months since June of 2024. So it could be a good opportunity for some momentum traders, but if you are looking to hold this stock for the long run, I would suggest there are other stocks which could suit your needs better. Again, purely just because intrinsically we are currently fairly heading into overvalued territories now. But I did say this exactly what would happen previously. I said around about here that this stock could break out, and it is exactly what has happened. It's just a shame that I missed out on this chance as my stop loss was triggered. Not a happy bunny right now. So I'm going to end that video here. I hope you have enjoyed it and found it somewhat useful. I'm not a financial advisor. None of this is to be taken as financial advice. You should always do your own research before buying into a stock, as when you do, your capital will be at risk. If you could leave a like and subscribe, it would be greatly appreciated. And with that being said, I will see you for the next video.